Yeah, just wait. I'm trying to sharing my PPT. Gamma. Yeah. So I'll explain about the mutual funds. So coming to the point, what is the meaning of mutual funds? How it is going to work, and how we are going to identify what is the features of mutual funds, so that I will explain today. So mutual funds means what? Mutual fund is a it is pool of amount which is collected from the small investors. So generally these mutual funds, no one is this generally these mutual funds, whatever the funds invested as a mutual funds, that entire amount is collected from the small investors. So whatever possible to them, that much amount they are going to invest in the under this scheme. So that entire amount, that pool of amount, again that financial institutions, wherever they are investing, so that they all are going to invest in somewhere and they'll get the returns. That return again they are going to distribute the among the yeah, that entire amount again it is going to distribute among the investors. So this is generally these mutual funds are very riskless investments, and also they will get the moderate returns, and no investor is going to face the any high risk. So generally whatever the small amount, whatever the saving have by the investors, that small amount they are going to invest. Invest. So what is the exactly meaning of mutual fund, and what is the features of mutual funds, what are the types of mutual funds, that all are I'm going to explain now. So here, meaning of mutual funds. Meaning of mutual funds. A mutual fund is a trust that pool of the saving of number of investors. Simply, it is a fund. It is a fund which is invested by the number of investors who share the common financial goal. The money collected is then invested by the fund manager in different types of securities. The income earned through this instrument and capital appreciation realized by the schemes are shared by its unit holders in the proportionate to the number of units owned by them. So simply, whatever the amount is collected from the small investors, so before collecting, when they collected at the time of that collection of the investments, they are going to allocate the units by the those who are maintaining that fund, those who are maintaining this scheme. So generally, it is maintained by the fund manager. Okay. So after that, collecting of the total amount is going to invest in the market in the different securities. Once he completed that investment, he is going to realize the money. Whenever when he is realized the money or when the capital appreciation is there, according to whatever the amount is contributed by the investor, according to that proportionate, again these capital appreciation also going to distribute among the shareholders. So this is the story of the mutual funds. Yeah, I'll share it. I'll share that. Yeah, see here about the mutual fund, about the mutual funds and overview. So mutual fund offers the versatility of tool for the investors to access the diversified the portfolio managed by the professionals. So the goal to equip you with the knowledge to the make the information informed to the investment decisions in a complex financial landscapes. So this is the overview about it. Sorry. And next one is the what is the difference between mutual fund unit and equity share? See, mutual fund is different, equity share is different. Equity share is the equity shareholders, they are the real owners of the company. But mutual fund holders, they are not the owners. So simply, they are the investors only. They are the debt providers only. And mutual funds diversification of fund is possible. But in whereas diversification of fund is not possible in the equity share. So in the mutual funds, diversification of funds is possible in mutual fund as money is pulled from the different investors and invested in the shares and bonds several companies. So as earlier I said, mutual fund is a amount which is collected from the small investors by the fund manager. After collection of that funds, he is going to invest it in the market with the different types of securities. But equity share is not like that. When the company is going to issue the shares, so either when your investor ready to buy the shares from the primary market or secondary market, so he will get the dividend on his equity shares. Generally, mutual funds are managed by the professional fund manager and they do adequate research before the investing of the funds any financial assets. So these all are managed and controlled and they are going to look that about the mutual funds, whether which fund is suitable for the investors, which is good, which is bad, which is having more returns. So generally, these all are maintained by the fund manager. This fund manager is a very professional person, and always they are going to do the research and investigation to invest the mutual funds. In case of equity shares, investment research is sole responsibility of the individual. So here, for example, I am the investor. If I want to invest in the mutual funds, generally I'm going to approach the fund manager. Fund manager can do the research and he will take the decision and he will give the suggestion for me. But whenever I want to invest in the equity shares, generally there is no fund manager. There is no advisor also. Sometimes some institutions, they will work as a advisor bodies, but maximum investor will take the decision which company is better, which funds are having the more returns. So it is purely investigated and research done by the investor individually only. You need to close the monitor the price movement in the both index like stock market, either BSE or NSEs. So based on that flow, investor will take a decision for the investment purpose. And next one is the mutual funds are sold from the units, and unit holders are not connected with the growth of the company. Generally, whatever I'm talking about the mutual funds, when you invested in the mutual funds, that is looked by the fund manager. When your amount transferred to the fund manager institution or financial institution, they will allot the number of units according to your price, how many mutual funds are allotted for you, so that all are going to be assigned, and it is only looked and research done by the fund manager only. This will not connected with the growth of the company. But in case of equity shares, investor become a shareholder of the company, and based on the performance of the company, investor may get the dividend or capital appreciation. So generally, when you are invested in the mutual funds, you are going to appreciate your fund. But if you are invested in the equity shares, every year, the based on the company performance, company profits, you are going to get as a dividend. Next, risk component. Generally, mutual funds risk is very less, very minimized risk we are going to face, as the funds are diversified into various companies. Generally, at a time, one place in one company, we are not going to invest. Generally, that whatever amount is there, whatever amount we ready to invest in the mutual funds, that all are invested in different companies. So because of this diversification, we are going to face the very less risk. Sometimes you will not get risk also. So minimum risk you are going to face. But whereas in equity shares, risk is very high as investor directly invested in the stock. See, if you purchase today, maybe this price will fall tomorrow. It may be increase or it may be decrease. So it cannot sure for the appreciation. It cannot sure for the depreciation. So it is uncertainty. So it may be, it can say that it is very high risk involved. Next one is the investment in mutual funds is easy compared with the equity investments. So whenever we are investing mutual funds, just once you open the demat account, once you transfer the money, that fund manager will take care about the everything. So compare with other equity shares investments, this one is the very easy. But whereas in equity share market will consume the lot of time and research. It is not that much of easy. Whatever we are observing in the mutual funds, so that much we are not going to get the easy facilities. In mutual funds, in case of mutual funds, unit holders don't have any option to change the stocks or bonds in the portfolio, as they are managed by the fund manager. But in equity share market, the shareholder can change. So whenever he want to exit from the market, he sell the his stocks, he can buy the other stocks of any point of time. They have a freedom to designing their own portfolio. So it means, so investor, whenever he is interested to liquidate his money, he can sell. If investor want to buy the other other investment pattern, other products, so he can sell existed one, he can buy the new one. But mutual funds is not like that. It is controlled by the fund manager. So it is depends on the type of scheme. Okay. Next one. to invest in the mutual funds, demat account is not compulsory. But to invest in the equity share market, demat account is mandatory. So mutual funds are involving the charge like exit load and total expenses ratio. But here in equity share market, brokerage charges need to be borne by the investor in the equity share market. And it is indirect way of investment in the share market. Mutual funds is an indirect way for the share market. On behalf of unit holder, fund manager will take the long and short positions of the market. But whereas in equity share market, it is direct entry into the stock market. Direct entry into the stock market. It consists of players like traders, investors, traded Arabs, short-term appreciation, share market, like this. So these are the difference between equity share market and mutual fund share market. So next one is the I want to share before I explain about the importance of mutual funds. Right. So as earlier I said, mutual fund means a collective investment scheme pooling of money from the many investors for the unified investment. It is expert management is looked by these investments. It is managed by the professionals who analyze the market and select the securities. He is nothing but I explained already about the fund manager. Diversification and accessibility. Spread the investment to reduce the risk. Generally, it means what? We are going to invest in the different companies. So making the market accessible for the retail investment, all the sizes. And that already over. Right. Yeah, this one also I already explained it. Mutual fund versus equity. So mutual funds represent the investor share of the funds pooled by the asset, priced based on the net asset value, whereas equity share indicated direct ownership of the company with the price driven by the open market demand and supply. So generally written, equity shareholders will get the dividends. Mutual funds provide the dividends. Mutual fund and capital appreciation also. Yeah. What is the importance of mutual funds? This one is the very important. First one is the diversification. Next one is the portfolio management. Professional management. Third one is the liquidity, affordability, conveniency. Diversification means what? See, diversification means generally investor want to invest his money where he will get the maximum return and to minimize the risk. So diversification means what? To reduce the investment risk by spreading the assets across the multiple securities rather than the single stack. Means what? For example, if he invested in one security only, if the stock prices fall, that entire amount is going to lost by the investor. For example, if investor is whatever his investment fund is there, if he invested different types of securities, for example, security A, security B, security C, security D is there. A having very less risk and high returns, and B having very high risk and low returns. So investor has a choice to invest which one is the giving maximum return and minimizing the risk. So that is called as a diversification. Professional management. So generally these mutual funds can operated by the very professionals. So skilled persons only they can operate. To access to skilled fund manager who actively research and optimize the portfolio to meet the investment objectives. Generally, this fund manager can always do the some research. So based on his knowledge, based on his findings, he will suggest to his investors. Liquidity and affordability. Generally, it is easy to buy and easy to sell that units. So generally, there is no restrictions. That entry and exit is very easy in the mutual funds with the low minimum investment of enable board market access. Conveniency. Simplified investments process with the consolidated statements and automatic reinvestments. So these are the importance of the mutual funds. What is the types of mutual funds? See, these types of mutual funds, there are different types of mutual funds also there. Here I only mentioned only few types which are important for us. See, generally, these types of mutual funds, we have different classification. That is, what is the different types of mutual funds? That is, one second, I want to share. Right. See, types of mutual funds. Generally, these mutual funds can classified four categories generally based on structured, based on asset class and investment objective and specialty of funds. So first one based on structured, again we classified into three categories. So based on structured, so based on structure means what? This is refers of how the funds operated in the terms of entry and exit and lifespan. So generally, these are the mutual funds are three categories. First one is the open-ended, close-ended. Second one, third one is the interval. Open-ended means what? And close-ended means what? And what is the meaning of interval? Interval means what? See, first one is the open-ended mutual funds. Open-ended mutual funds means generally these mutual funds will provide high liquidity to the investors and there is no maturity date for the mutual funds. So anytime he can buy and he can sell. Investor can buy and sell the units any point of time. There is no restrictions, and for number of years also there is no maturity time. So this is called as a open-ended fund. Open-ended fund means what? The mutual funds which do not have any maturity date, and mutual fund holder have a right to buy and sell any time, and these funds will provide the high liquidity. That is called as a open-ended fund. Close-ended fund. So it is quite opposite to the open-ended fund. Generally, this close-ended fund having that fixed maturity period, first of all. And units can be brought only during the new fund offer only. So whenever we purchase, whenever they will issue, that time only we are able to buy. And these close-ended funds can listed in the stock exchange, but open-ended funds cannot listed in the stock exchange. What is the interval fund? Interval fund means it is the combined feature of the both open-ended funds and closed-ended funds. It is the combined feature of the both. So that is called as a intervals. Next one is the based on asset class. So based on asset class, there are some types of securities are there in the mutual fund investments. First one is the equity related. Generally, these mutual funds invested in the mainly stock exchange, stocks in shares, and it will give the higher returns, and at the same time, investor will face the higher risk also. That is equity fund. Debt fund. Debt fund means it invested in the fixed income instruments like bond and debentures. And sometimes in money, short-term financial instruments like treasury bills, low risk commercial papers, stable returns. So these all situations, these investment mutual funds are going to invest. Next one is the hybrid. Hybrid fund means it is mix of equity and debt funds. So balance return purpose, this it is a mix of the debt to equity for equity and debt and equity. Next one is the money market. Generally, these mutual funds are invested in the short-term debt instruments for the high liquidity purpose, at the same time low returns. Generally, whenever you are invested that in the money market, you will get the low returns only. Next one, commodity funds. Though here mutual funds are invested in the physical commodities like gold, oil, etc. And real estate funds indirectly invest in the real estate through the REITs. Next one is the investment objectives. So based on the objective, growth purpose mutual fund types, mutual funds types, based on the objective of the investment, we classified growth mutual funds, income mutual funds, tax savings, and capital preservation. So growth means what? Aim for the capital appreciation purpose. Generally, these mutual funds invested in the equity. Next one is the income. Provide a regular income to the investors. Focus on the bonds and dividing the paying of stocks. Tax savings. Generally, offers the tax reductions under Section 80C. Examples, equity linked savings schemes. So these are the different types of mutual fund. Sometimes special funds also we are going to observe. That is in the special funds, index funds, sector funds, funds of funds, thematic funds, international funds, exchange traded funds. These all are the different types of mutual funds. So among these all, very important mutual funds are open-ended and close-ended, and that based on the asset class, equity, debt and hybrid, and based on the investment, growth mutual funds, income mutual fund, stock mutual funds. These are the very important. See, here also, the combination of all I mentioned here, equity funds, debt funds, hybrid funds, and money market funds, sector funds. So here I not mentioned that closed and open-ended funds. So that also the different types of mutual funds only. So I already explained this one. Next one is the risk involved in the mutual funds. See, there are different types of risks we have. So what is the risk? Risk is uncertainty, first of all. Risk is uncertainty event for our investment. So some types of risk also involved in the mutual funds. What are the types of risks are involved? First one is the market risk. Second one is the interest rate risk, credit risk, liquidity risk, and inflation risk. So market risk means what? Fluctuating the asset prices due to the economic or political changes in particular country. So for example, if you take that last 1 week or last 1 month onwards, there is a war situation. So due to that reason, the stock markets totally collapsed. So that is the fluctuation of market. That is the risk of market. Next one is interest rate risk. The bond value may be declined if the interest rates rise. So interest rate risk means what? Whatever the bond value is there, if the bond values decrease, for example, 1,000 rupees bond value is there, it is decreased to 500 rupees. So instead of that, when the original price is decrease of the bond, so the rate of interest also it is going to be burden. So bond value may be declined if the interest rate side. And credit risk, possibility of issuer default on the bond payment. Liquidity, it is very difficult to selling of the asset liquidity with the price of conversion. Inflation risk, return may not keep with the pace with the rising of prices. So these all are there in your material. Go through once. Yeah. Yeah. Next important topic is factors to consider in mutual funds selection. So generally, what are the factors we are going to consider? Generally, here we have to check past performance before investing. Second one is the asset size. Third one is the load status. Fourth one is the investment style. And what is the risk and age of the mutual fund scheme. So these all are generally we are going to check. So these all the factors are going to be influenced. So past performance means whatever that movement is there, that mutual fund, whether is increasing or decreasing that. So based on that, it measured by the return through the net asset of the mutual funds. If the net asset value is continuously if it is increase. So that funds we are going to be choose. That funds are we are going to choose and we are going to select. And the asset size. The size of the mutual fund is total market value of the all securities held in the portfolio asset management funds. So that asset management fund of funds institution has described it is the assets under the management of the mutual funds. Expenses ratio. Generally, expenses ratio talks about the lower fees enhance the returns. Consider the track record for the consistent of performance. And what purpose we are investing? What is the goal of that investment? So you want to expand you want to appreciation of your capital, or you want to liquidate your funds, or you want to get the minimum returns. So like that, what is the purpose of your investing? So as per the purpose, whether it is suitable that particular fund or not, we have to check. And fund manager also very important for the asset allocation. When the experienced and effective fund manager is there, he will do the good research to invest which funds are more better. So after analyzing of that, then only they are able to invest. And experienced the managers and diversified portfolio generally yield better realized estate. So this is the factors are influenced by the before selection of mutual funds. Sir, sir. Okay. Awesome. So these are the different types of mutual funds. So go through once. The next chapter is yeah. See, next chapter is mutual constitutional and management of the mutual funds. See, constitutional and that is next one is the mutual fund constitution and management. So generally, sponsors and trustees. Who is the sponsors? Who is the trustees? The sponsor is the entity that initiated the mutual fund. So generally, these sponsors are comparable to the promoters of the company. So generally, behalf of the companies, the financial institutions will do that. Next one is it must have the soundtrack record of the financial integrity and good reputation. Most of the contributes at least 40% of the net worth of the asset management company need to be approval from the Security Exchange Board of India. So sponsor means what? Sponsor is the entity that initiative the mutual funds and comparable the promoters of the company. It must be soundtrack of the record. Most contribution at least must contribution at least 40% of the net worth. And also it is need to be approval by the SEBI. So examples of that sponsors and trustees, State Bank of India, for the SBI mutual funds, ICICI Bank for the ICICI Prudential mutual funds. So these all are the sponsors. So simply sponsors means what? So they are going to issue, they are going to operate the funds behalf of the companies, and investors also they are going to invest in the this under the through sponsors only. Trustee. Trustee is created under the Indian Trustee Act 1982. Mutual fund is registered as a trustee. Generally, whatever the mutual fund is registered, it is as a trustee. So this can work according to the Trustee Act 1882. Trustee hold the property of the mutual funds that in the trustee for the benefits of unit holders. Ensure that asset management companies functioning the interest investor the complaints of SEBI regulations. It can be both the trustee and trustee companies. Who is the asset management company? What is the role? So general asset management company is appointed by the trustees to manage the investment of the fund. So it acts as the investment manager, and also it is compulsory need to take the approval from the Security Exchange Board of India. These asset management companies designs mutual fund scheme, collect the funds and invest in the behalf of investors. So this asset management company can act as a intermediaries of investors and companies. So that mutual fund related all are will take caring by them only. They are the responsible for the research, portfolio constructions, complaincy, and performance tracking. This asset management companies earns the management fee from the scheme. So generally, investor get the returns, company will pay the returns, but asset management companies, they will get the, for operating of that schemes, they will charge certain fees for them. So these asset management companies, examples are HDFC Asset Management Company Limited managers, HDFC mutual funds. Next one is the custodian. Custodian means what? Custodian is a responsible for holding the safeguarding of the securities assets in the mutual funds. They ensure that proper settlement trades, safe custody or corporate actions like dividend and investor bonus issues. Custodian must be independent of the asset management company. So generally, these custodians must be independent. Next one is the launching of mutual fund scheme. First of all, we need to follow some steps. First, asset management proposal we required. Asset management companies propose the new fund schemes with the objective and strategy. First of all, they need to tell, and approval by the trustee. Trustee review the approve the proposed scheme and filling with the SEBI. Offer is document or draft scheme information with the SEBI, filling with the SEBI, and SEBI approval we need to take. Then new fund offer we are going to open that allot. After open that new fund allotment, we are going to allot the units. Then scheme become a open continuous sale for the repurchase. And paces of growth of mutual fund industry in India. Generally, these paces we classified into 5 levels. So first one is the phase 1, pre-1987 to monopoly of that UTI. UT trust of only there is a before pre-1987 there is a from 1962 onwards, that is the only UTI is there, that is Unit Trust of India. The existed establishment, that is 1963. It is launched this scheme 1964, US 64, that is dominated the Indian mutual fund space. And phase two, in the year of 1987 to 93, entry of public sector banks like SBI, LIC, GIC, UTI's monopoly ended. Then these public sector banks are enter into the market and growth of the investor base of the asset under management. Next one is the phase three. From 1993 to 2003, the entry of the private and foreign players. It is introduced by the SEBI regulations 1993 Act regulations 1993. The entry of the private sector and foreign mutual funds based on the example Kotari and Pinal. It is increased the competition and innovation of the scheme, more professional fund management also. In the phase 4, from 2003 to 14, consolidated and regulation, UTI split into UTI AMC and SUUTI, the legacy of assets. So next one is they started a new scheme, new investment plan, that is the SIP. It is called as a systematic investment plans. The tech adoption also done in the fourth phase. And now we are in the fifth phase from 2014 onwards. It is a purely digital and electronical participation involved more, and such the digital platform and mobile apps and massive retail investors growth for the especially through the SIPs mutual funds becoming a mainstream of the investment vehicle. It is introduced by the direct plans, ETFs and international funds. So this is the story of the trustees and sponsors. So next topics we are going to discuss next class.